Alibaba stock. So I love this stock as a buy for 2024 overall, and I have spoken about that here recently, right? Now, you don't understand, there's something going on with Alibaba. It's very intriguing. They got a massive share buyback on right now. They used about $2.9 billion in their latest share buyback here. They repurchased about 3.3% of the entire company, right? Now, they should continue to buy shares and buy shares. The best case scenario for, let's say, Alibaba for 2024 is the share price remains cheap. You shouldn't really want Alibaba to go on a big run here in the short term. And the reason being is if you're a buyer of the stock in 24, you can buy as many shares as possible for as cheap as possible, right? Would you rather buy Alibaba at 70 or buy Alibaba at 170? Or 270, like obviously you'd rather buy it at 70, you can buy a lot more shares and accumulate, right? So you want it cheaper so you can buy as many shares as possible, but guess what? You also want it as cheap as possible so Alibaba can buy as many shares as possible. Why they got this big share buyback on right now, right? The more shares they can take off the market, the more it's gonna help your EPS long term. It is huge, huge.
Worst start to a year in over 2 decades. This will trigger the next market sell-off. Get out now, as I sold out of D stocks. Yes, indeed, I have sold out of my Art of Trading long portfolio before I recorded this video. For the reasons I'm about to share with you, stick with me till the end to find out which exact stocks I sold out and book trading profits on. If you are in my Art of Trading / Art of Investing program, congratulations on the fat easy money for a short 2 months swing trade. I am sure there are plenty of opportunities in the market as we dive back into the source of trigger for the next market sell-off. If that's not already happening, are you ready? Brace yourself for this frightening reality. Jim Cramer said he is extremely bullish for 2024. That is one red flag. Jim Cramer on Bitcoin. You can't kill it. It's a technological marvel. This is the second red flag. On CNBC, Tom Lee is saying that the U.S. labor market is strong and robust. And over the holiday season, consumers went out and bought on that narrative, believing their job was safe and secure. Ha 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 ha. And when you see what is coming this year, it's going to be outright frightening.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
And the damage is going to do to the U.S. economy will be unrepairable. Feds bark and say soft landing looks more likely but not inevitable as central bankers, he says, are making real progress on inflation. And this is exactly what they believe. If they bring demand down in the form of inflation and the labor market holds up, that they win. And not just win, is for the first time in history. Because we can go back and look at central banking over the decades, and we can find that there's not one bit of evidence that they have ever nailed a soft landing. But today, what do we see is people piled into the U.S. equity market. They've been outspending on their credit cards. They buy now, pay later loans, all on the belief that the labor market is going to hold strong. But as you'll see soon, there's no chance at all. The soft landing is increasingly conceivable, he says, but in no way inevitable. And Barkin is voting on policy decisions this year, making anything he says very important. As we come up to the next FOMC meeting, demand, employment, and inflation all surged, he said, but now seem to be on a path back to normal, which is true. The problem is, what he doesn't realize is that normal unemployment is actually higher than its current level. In fact, if it continues to go up, it's going to have a damaging effect on the U.S. economy, one that will send us deep into a recession. Embarking to find a flat landing as inflation returning to normal levels. Well, the economy stays healthy. Notably, he doesn't decide what healthy is. He leaves that up to interpretation. As he said, inflation is coming into the range of our 2% target in a 6-month core inflation, which excludes food. Energy prices is running slightly below target. And of course, what we know they mean by healthy economy is one that you don't lose your job, or at least, well, not that many people will lose their job. The problem, as we get into what happened in the news today, you're going to see that the worst case scenario for the U.S. worker is indeed coming this year. And while Barkin acknowledged that the most officials are expecting cuts in 2024, that conviction on both questions of inflation continuing descent and the broader economy's performance will, quote, determine the pace and timing of any changes in rates, of course. What we have noted on the show, inflation indeed coming down because demand is coming down. And of course, there's absolutely no correlation to the federal funds rate and the consumer price index, despite what these central elites want us to believe. In the end of the day, they're going to be lowering rates, and not just once or twice like they think they are once the path down starts. It's going to accelerate in a big way, as you see on its way to zero. The Richmond Fed president laid out several risks for the economy this year, including how recent plunge in long-term interest rates could stimulate too much demand and keep inflation elevated. Do you believe these experts from the central bankers? Let me know in the comment section below. Do you think they know everything? I will continue to say that they are completely clueless. Well, I want you to see, let's go back and look at what he says. I want to provide you the evidence. He said a recent plunge in long-term interest rates could stimulate too much demand and keep inflation elevated. And what he's suggesting here is that as rates go down, people are going to consume even more. But there's one easy way to prove that this isn't true at all. Because Barkin doesn't understand that a decline in long-term interest rates means growth and inflation expectations are headed down. It doesn't mean it's stimulus to the economy. And here you can see in this chart the consumer price index in blue, this shown on year-over-year rate change against, of course, the 30-year Treasury yield. And what we should see then, if he is correct, is that when the 30-year Treasury yield goes down, well, inflation in terms of demand should go up. When in fact, the opposite happens. As we go back here into the 80s, and why the 80s matter so much, it's simply because we're now a global economy. And as time passes, since we become more in sync, and we do know to here you see in red, the 30-year Treasury leading the consumer price index down. You see it going into the dot-com bubble and the recession there again. 30-year yields leading the CPI down. How about the global financial crisis? Once again, inflation did surge a little bit on the backs of oil prices. But the bond market said no way, and sure enough let inflation lower. You see that in 2014, going into 2016, as we're facing a global synchronized recession, how about heading into the pandemic? You got it. The rates fall well ahead above of that, and inflation, and today again, they see the view here is that it leads to a stimulative effect when in fact it does not, because they don't understand what drives rates. They don't understand the monetary system. Because when you constrain the creation of credit in our system, you start to pull back the range of growth. And that's only part of the issue, because when you have a lot of debt in a debt-based system, well, you need money to pay on it. In fact, you need money created by new debt to pay on the old debt. And what happens when you invert the yield and money curves is rates come down because the monetary system starts to fracture on its way to breaking, and it suggests if rates don't come down and new money isn't created, that something bad like a financial crisis will occur. When we know the situation is going to get much worse and that rates are going to lead the federal funds rate down, which is something Barkin doesn't get, and he didn't give his expectation for interest rates with any specificity. Well, of course not. They never do. And he said central bankers would respond to incoming data. Of course, we know the incoming data is heavily lagged, which is why the Fed is always behind the curve. He said conditions are ever evolving, and so too will our approach. So buckle up. That's the proper safety protocol, even if you expect a soft landing, suggesting he has no clue what's about to happen. But one thing that we do know is the Fed is going to cut rates here, because remember, they always go to a new low. The problem is we've been at zero twice now, suggesting if we get back to zero again, which I believe we will, it will have no stimulative effect in the US and global economy. We'll be in dire shape under that condition. So now, as we set the stage here that the Fed thinks that you're going to see a soft landing and that your job's safe, let's start to look at what's happening around the rest of the economy as we get into what the real problem that is now surfacing that says bad things indeed are coming soon. Because one of the challenges here is everybody is hyped up on the US stock market. They're piling in the US equities. They think the next bull market is coming. With have us investors, retail investors, foreign investors all want to buy US stocks. And if you look at the correlation between the Wilshire 5000, which is a total US stock market, against the job survey in blue, it suggests the US stock market is likely to head lower here, which would have a secondary effect. From my Art of Trading account, I am happy to report that Tesla stock I bought at 215, sold at 252, 17% gain. Not flashy enough for you. Okay, how about Roku? I bought the dip at $56, sold it at 102, at 82% gain for just one short month. Because if you understand that rates are going to come down, I've given you the signals here to buy at a low position. We give you warning signs and when you should take your profits and get out. And I took a home run of a profit with Palantir and Coinbase. You'll see, like many of our other subscribers, just how easy it is to make money. This is an outright frightening scenario where we're going to see an increase of layoffs on equity market come down, and those even on unemployment, which is meant to be the safety net, are not going to have the income they need to pay their bills due to high interest rates and high inflation. It's going to lead a massive contraction in the money supply. And that, my friend, is what is coming this year that is so frightening.
Subscribe, like, turn on those notifications.